KKR and the private equity Playbook, Barbarians and Builders. New York, early 1980s. In a side room of a charity dinner, three men in dark suits lean over a set of numbers. They're not arguing about the dessert, they're arguing about debt. How much a tired old conglomerate can bear. How much cash its divisions really throw off. How much they can borrow against it, take it private, break it up, sell the pieces. To most of the guests outside, this is just another corporate name printed on brochures. To these three, it is something else. An opportunity. Their names are Jerome Kohlberg, Henry Kravis, and George Roberts. Together, they build a firm called KKR. And they will help turn a niche tactic into one of the most controversial and influential tools in modern finance, the leveraged buyout. Before the headlines and big game hunts, KKR's story starts quietly. In the 1960s and early 70s, Jerry Kohlberg works at Bear Stearns, a mid-tier investment bank. He becomes interested in a certain kind of deal, buying small, unloved divisions of larger companies using a mix of a little equity and a lot of borrowed money. The idea is simple. You find a business that generates stable cash flow, but that its current owner does not really care about. You borrow money, secured mainly by the company's own assets and earnings. Use that borrowed money plus some equity to buy the company. Then you use its cash flow to pay down the debt. If things go well, the equity, so your slice, becomes very valuable as the leverage shrinks. These are early leverage buyouts, though the term is not yet famous. Kohlberg brings in two younger colleagues, Henry Kravis and his cousin George Roberts, to help to do more of them. They like rolling up their sleeves, visiting plants and warehouses, talking to managers. They're not just shuffling paper. They are learning how these businesses actually run. Over time, they decide they want to do this outside the confines of Bear Stearns. In 1976, they leave and create their own partnership. Kohlberg, Kravis, Roberts, and Co., KKR. From the outset, KKR's approach has a few core elements. They do not just buy small stakes, they buy control. They want the ability to hire and fire top management, to sell divisions, to change strategy without asking anyone's permission. They put in some of their own money alongside that of outside investors, aligning their fortunes with success or failure of each deal. And they use leverage, lots of it. To the critics, leverage is a loaded gun. It magnifies returns on the upside and pain on the downside. To KKR, it is discipline. A company saddled with big interest payments cannot afford to be sloppy. It must cut waste, focus on core strength, generate cash. This logic is not crazy. It can also be brutal. In 1988, KKR steps into a deal that will define its public image for decades. RJR Nabisco. A sprawling conglomerate that makes everything from Oreos to Camel cigarettes. It has big brands, big cash flows, and, in the eyes of some, big complacency. The company's CEO, F. Ross Johnson, hatches a plan to take RJR Nabisco private in a management-led buyout. He lines up financing. He expects a relatively smooth path. He does not get one. Once the bid becomes public, other players circle. Investment banks and private equity firms smell blood in the water. The board opens itself to competing offers. KKR charges in. What follows is an extraordinary bidding war, captured in all its messy detail in the book Barbarians at the Gate. Conference calls and midnight meetings, jockeying between Wall Street banks hungry to underwrite ever larger piles of debt. Lawyers arguing over fractions of a dollar in the offer price. Executives pitching themselves as better stewards than their rivals. In the end, KKR wins with an offer of around $25 billion. The largest leveraged buyout in history at that point. The nickname sticks, Barbarians at the gate. The image is irresistible. Raiders storming the castle of corporate America, battering down the doors with borrowed money. The reality of the headlines is less cinematic. RJR Nabisco, laden with debt, struggles under the burden. Interest payments eat into its flexibility. Pieces are sold. Operational improvements are made, but the initial expectations of profit for KKR's investors are not fully met. The deal is not a spectacular disaster. It is not a miraculous home run. It is messy, expensive, and complicated. But as a cultural moment, it crystallizes something important. Corporate America now knows that being public does not make you safe. If your stock is cheap relative to your cash flow, if you are seen as bloated or mismanaged, someone with enough nerve and enough lenders can try to take you over. Boards take note. Managers start thinking differently about how much fat they can afford to carry. KKR is no longer just a firm doing deals. It is a symbol of new kind of discipline, or a new kind of threat depending on where you sit. So what is the private equity playbook KKR helped to popularize? At its core, it is a sequence. Find a target, usually a company with predictable cash flows, underperforming margins, non-core assets, or poor management. Raise capital. A fund pools money from pensions, endowments, wealthy individuals. That equity is then multiplied with debt borrowed from banks and bond markets. Buy control. Acquire a majority stake, often taking the company private and delisting it from stock exchanges. Change things. Replace or support management, cut costs, sell non-core divisions, invest in promising areas, tighten working capital, tweak pricing. Whatever the analysis suggests will improve value. Exit. After several years, once debt has been paid down and profits improved, sell the company to a strategic buyer, another PE firm, or bring it back to the market in an IPO. If all goes well, the investors in the fund see strong returns on their equity. If it goes badly, lenders may take a hit, the company may falter, and jobs can be lost. KKR did not invent this from scratch, but they refined it, scaled it, and shadowed how to do it over and over, not just in one industry, but across many. Private equity, especially in its KKR-branded 1980s form, inspires strong reactions. Workers in acquired companies often experience layoffs, benefit cuts, intensified performance pressure. Communities can see plants close, long-standing divisions sold off. Headlines about vulture capitalism and asset stripping appear. KKR and its peers respond with their own narrative. They say they are not destroying companies, they are fixing them. They argue that many targets have been neglected by sprawling conglomerates, starved of investment, or weighed down with bureaucracy. Private ownership, in this telling, allows for faster decision making, a sharper focus on what works, and the courage to do painful but necessary surgery away from the glare of public markets. Sometimes both stories are true. There are deals where private equity firms clearly squeeze value out mainly by cutting, flipping, and moving on. There are deals where they invest heavily, professionalize management, and leave a company stronger. KKR experiences both kinds. Over time, they start to emphasize the second story more, hiring industry experts, talking about value creation beyond cost cutting, holding some assets longer, especially in infrastructure and growth areas. The barbarian costume does not fit quite as comfortably when you are courting pension funds in Scandinavia or sovereign funds in Asia. The firm that began as a scrappy trio doing buyouts of neglected units becomes, over decades, a sprawling investment platform. KKR raises ever large funds. It expands beyond classic buyouts into growth equity, credit fund, infrastructure, and real estate. It opens offices around the world. It goes public itself, listing shares so that ordinary investors can own a piece of the management company and the fees it generates. Its executives start to sound less like raiders and more like diplomats, talking to governments about public-private partnerships, to CEOs about long-term strategy, to unions about job preservation. The core playbook, buy, improve, exit, remains, but the toolbox broadens. What KKR and firms like it offer to their investors is something different from what BlackRock or Vanguard offer. Index funds give you exposure to thousands of small slices of public companies with daily liquidity and low fees. KKR offers exposure to entire companies, or big chunks of them, in structures where your money is locked up for years, with higher fees, but the possibility of higher returns. The price of the potential extra return is illiquidity and complexity. For big institutions, so pension funds, endowments, sovereign wealth funds, this is attractive. They have long-term obligations. They can't flee at first sign of trouble without causing their own problems. They need returns that beat plain vanilla bonds and stocks if they are to meet future payouts. So they allocate a portion of their portfolios to alternatives. So private equity, private credit, hedge funds, infrastructure. KKR is one of the magnets for that money. One of the enduring intellectual contributions of KKR's era is the idea that capital structure, how much debt versus equity a company uses, is not just a footnote. It is a lever. Too much debt and you risk insolvency when earnings dip. Too little and you may be leaving cheap financing on the table, dulling management's urgency. Private equity firms, at their best, engage deeply with this question. They model scenarios. They argue about sustainable leverage. They negotiate covenants with lenders. They sit on boards and remind executives that missed targets are not just embarrassing. They can be existential. To some, this is value-creating discipline. To others, it is a permanent state of brinkmanship imposed by financiers on people just trying to build products and serve customers. KKR lives in that tension. By the time you read about KKR in the financial press today, the Barbarians at the gate tagline feels almost nostalgic. The firm sponsors sports stadiums, funds scholarships, touts ESG frameworks, invests in renewable energy and digital infrastructure. The deals are still complex, the sums staggering, but the tone is more corporate citizen than castle raider. Yet, underneath the PR, the basic blueprint they helped legitimize remains a pillar of modern capitalism. Underperforming public company? Potential buyout target. Family-owned business without a clear succession plan? Potential buyout target. Division inside the conglomerate that no longer fits the strategy? Potential buyout target. In each case, a fund somewhere is running a model asking, what if we owned all of this? How much could we borrow against it? What could we change? What could we sell? How much could we make? But KKR is only one branch of a larger tree. While it was perfecting the leveraged buyout, other firms were building complementary empires in the same shadow world of private capital. Blackstone took shape as a deal shop that would eventually expand into real estate, hedge funds, credit, and infrastructure, becoming a kind of supermarket for illiquid investment. In Switzerland, Partners Group grew from a small Zurich area firm into a global manager specializing into private markets, convincing institutions that locking up money for a decade could be a feature, not a bug, if it meant access to a different kind of return. Together with KKR and others, these firms helped redefine what it means to invest. Not just in stocks and bonds you can sell tomorrow, but in assets you can't touch for years. Toll roads and office parks, wind farms and warehouses. Private loans to mid-sized companies you'll never see in a ticker. An illiquid empire, where the reward for patience and complexity is supposed to be a premium. Next time, we will move from the drama of single company takeovers to this broader landscape of alternative assets. We will visit Blackstone's Glass Tower and Partners Group's Swiss campus and see how they turned the old private equity book into a diversified universe of funds and vehicles that now sit in the portfolios of almost every major institution on Earth. If KKR showed us how a small partnership with a taste of leverage could break down the gates of corporate America, Blackstone and Partners Group will show us what happens when that energy is channeled into building entire private markets, where capital and assets circulate mostly out of public view, but shape the world you live in all the same.